India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Tuesday morning. We are, of course, coming after the sharp fall that we had yesterday. Global markets overnight are a little okay. Lots to discuss. And, of course, we are also one day before a market holiday, midweek holiday. I'm Prashant. With me, my colleagues, Surabhi and Nigel. Guys, hi, good morning.
Explains the bright smiles on a Tuesday, But, yeah, I think the midweek holidays actually right in the center of the week. They come right there when needed.
Well, indeed. And in fact, you have quite a few Asian markets that are shut today.
Yeah.
So our turn is tomorrow. So let's get straight to the trading session then.
Absolutely. And, so U.S. equities, I'll start there because we'll get to, of course, yesterday's session, which was down and out, right? Completely down and out. So U.S. equities last night managed a small gain, and actually on the S&P, not such a small gain as well, about 0.4% on the S&P, but it came in the last final minutes of trading. I mean, they were actually down for most parts of the day, and then towards the close, they kind of went up a little bit higher. The S&P, as a result, of course, made a new all-time high, 0.4% higher. And I think what kind of flipped the market a little bit at the margin, if you can move along, is that markets digested commentary from Powell that re-emphasized the strong footing of the economy. It's, as we described it when it happened, kind of a happy situation that the economy is strong, but rate cuts are coming. Maybe not 50, maybe 25. And I think that was the other thing, right? Comments from Powell reinforced likelihood of 25 basis point cuts. At the time when they had cut by 50, he'd said in the press conference, well, don't make this the base case that every meeting you will get a 50. And yesterday, I think some of those comments were reinforced. But that was because the economy is in a good shape. So you don't need 50, you need 25. So anyway, markets reacted. Dollar also bounced. It's been bouncing from this support zone of between 100.5 and 100.8. And it went up about 1/3%. Those are important support levels we've kind of held on to. We left off at about 100.75. Now, China, of course, was the big story, has been the big story for the last many days. But remember, as we've been saying since yesterday, perhaps part of the reason why there was such frenzied FOMO kind of buying yesterday was that, Chinese markets, at least mainland market, the Shanghai Composite, Shenzhen, those markets are shut for a week starting today. They're not trading today, and they won't be trading all the way till the 8th of October, which is a Tuesday. Which is the 11th of October. That is, about a week away from now. Now, the Hong Kong markets are shut today, but only for today, and they restart trading tomorrow. A lot of people play Chinese stocks via the Hong Kong route. The Hong Kong Chinese Enterprises Index is a sort of apt route through which global investors access Chinese markets. The Shanghai and the Shenzhen is more oriented towards retail Chinese investors in any case. Let's just circle back the levels to what we saw yesterday. The Nifty and the Bank Nifty, they very quickly, as we started, broke through hourly averages. It kind of indicates short-term weakness. That's point number one. And as I said towards closing yesterday, the 20-day moving averages, both on the Nifty and the Bank Nifty, are the important support levels now. For the Nifty, that level stands at about 25,480, 479 to be precise. For the Nifty Bank, that level is 52,476. That's a 20-day there. Hopefully we will not break that even if we come close to it. Those levels are not very far away. Bad day or two and you'd be there. But the fact is that, those are important short-term reversal markers, and hopefully they will not go. Now, lots of stuff has come from SEBI, and we will talk more about this, but F&O restrictions did not come. Those F&O rules did not come. But I would say, again, they are expected soon. Just because they did not come yesterday does not mean, I think they are imminent, and we'll see that over the next couple of days or so. Market holiday tomorrow, I think, which perhaps also means that action may be a little more subdued, which is not a bad thing after the complete bashing that the market got yesterday, especially on large caps. GIFT Nifty will come up on your screen, gives you an indication of how we are likely to start. It's about a 10-point higher start. So absolutely flat, nothing on it. Surabhi.
Absolutely. And Prashant, which is why I want to start first with the fund flow picture.
Yeah.
First up, looking at the number. And as we were expecting, while this huge large cap fall was playing out yesterday, it has been driven by a lot of FPI selling. And the critical question is, was it a one-off, or will there be more such tactical shifts, perhaps because of what's happening in our neighborhood with the large markets like Japan and China? The sell number yesterday was 9,791 crores, almost 92 crores. So near 9,800 crores worth of selling coming in from FPIs. Domestic institutions cushioned a lot of that selling with a buy figure of about 6,650 odd crores. But clearly it wasn't enough. So this is a very critical watch point where the cash market selling will continue to be as large or whether it was just one-off. Let's move to the macros. Got lots of data on the economy. And just to kind of give a summary, the fiscal deficit numbers are looking really good because the April to August year-to-date deficit number is a lot lower than the same period last year. We're at about 27% of the FY25 target, so that's also good news. And the help is coming in from the fact that tax buoyancy is amazing this time around as well, with the tax collections crossing 13 lakh crores already. Talk about the August 8 core industries data. Now that's negative because there's a decline of 1.8%, so very sharp contraction coming through. And a lot of the sub-constituents like coal, electricity, etc., all of them are in negative territory. Look at the CAD number. That's also a slight negative cue from the macro standpoint because we have swung back into a current account deficit versus a surplus in the previous quarter. So quarter on quarter, there's a variation. The current account deficit is about 1.1% of GDP right now. The reason why we're back in deficit is because of a mismatch or a imbalance between exports and imports. Merchandise exports have grown actually quite well, over 5%, but imports have been surging as well, and therefore the problem. Let's come to the SEBI board meeting, and we'll discuss this with guests throughout the course of the day. Lots of very interesting developments come through, so keep this on your radar. First of all, this new asset class that's been declared, so mutual funds, asset managers, listed companies, they'll be in focus as well because it's a brand new product that sits in between mutual funds and PMS. It's finally been cleared. Then the whole MF light approach to passive funds, that's been green lighted as well by SEBI. So that's something to keep in mind. And then one of the most important things is the expansion of the definition of connected persons. And we'll discuss this with experts and sort of people who have a legal view as well, because this is a big one. Now, connected persons will include the partner of a company, that company's employee, other partners in that company, and also members of a household. So if there is a connected person in one house, automatically everybody else who's living in that house also becomes a connected person. And likewise, the definition of, broader definition of relatives has been now used instead of immediate relative. And it's been really expanded in terms of spouse, children, children's spouses, so sort of a whole family tree that gets covered with these latest changes in terms of the definition. So we'll watch out for this. And finally, I'll also watch out for the gold financing stocks. RBI yesterday came out with an advisory. It's an advisory. It's not a new ruling. They're not shutting down anyone's business. But the advisory was very interesting to note because they're saying that there is a lot of gap in terms of compliances when banking correspondents are involved or third-party service providers are involved, and gaps even otherwise in terms of, maintaining important compliances, whether it's loan-to-value norms, risk weights, auctioning of gold in case there is a default. And also there is a lot of concern about perhaps inadequate due diligence when the gold loan is actually being given out and the end use, monitoring the end use of gold loans. So let's see, stocks like Manappuram and Muthoot will be on the radar as well. So plenty of local action too today.
Well, that's right. And nothing untoward really came in post-market hours yesterday. I think that'll be a relief because Fed's Powell, well, he didn't sound overtly dovish, but the markets took it in its stride, and I'll view that possibly. That was one fear. The other fear was that maybe SEBI comes out with something that could be drastic. That as well didn't play out. So both these fears didn't play out, and the bulls will be looking at both these points with the relief. The problem is the FI selling. That was nearly 10,000 crores, the highest we have seen all the way since August 5th, and we'll have to track this number. Are FIs in the mood of offloading more amount? That's something that we'll have to track very, very closely. But the last time around when they sold, the next few days, in fact, they turned things around. So we'll keep an eye out on that front. What about the FIs in the FNO market? Well, yesterday they unwound some longs, so there was no shorts that were added in the system. They continue to remain net long with 81% of their positions on the long side. On the client side, well, we had a big dip yesterday, and the clients that actually have got it right, well, they covered some short positioning out there. And net, if you look at the positioning now, The FIs, they're net long, but the long positioning has come down a little bit because of that unwinding that we have seen. While the clients, well, they are net short at around 1.9 lakh contracts or thereabouts. Today is going to be a big day because we have the dual weekly expiry that plays out. That's the Nifty Bank as well as the Nifty Financial Services Index. And these two are going to be the movers today because financials as well as banks have got hit in the last two sessions. The Nifty Bank has corrected 1,500 points in just two sessions. Could be due for a bit of a bounce. On the downside, the reference level you're looking at is closer on 500 points away from where we closed yesterday. That's at around 52,450 odd. While the recent high, well, that becomes a bit of a resistance. I think the Nifty Bank could be due for a bit of a bounce in today's trading session. And both the Nifty Bank as well as the financials, they'll give direction to the market today. On the Nifty PCR, that's come back down to around 0.8 odd because of the kind of call writing we have seen and the kind of put writing that we've seen. So in terms of a level, since we saw 26,000 call fairly active, the 26,050 odd mark, that becomes a bit of a resistance zone. So if we bounce, you want to get past the 26,050 odd mark. On the downside, well, the reference point comes in at around the 20 DMA. So you'll feel more confident once you get past this mark. Stocks that I'm looking at the cement stocks, and a few of those larger cap names should be in focus as well because it's the end of the monsoon, so construction activity picks up. You'll hear from somewhere today that there's a price hike that's been pushed through. How much of it gets absorbed is going to be important. And the third point is petrol prices have cooled off, so petcoke prices as well at multi-month lows. Keep an eye out on the cement stocks for the second half of this year and also from today onwards, given that monsoons are behind us.
Okay, all right, got it. We'll watch out for all of those cues. Let's kick off the action then with the equity call of the day. We've got actually two big calls coming through. First one is from Rhythm Desai of Morgan Stanley. He says the market, especially small and mid caps, continue to defy gravity and climb a wall of worry. He expects strong growth signals in the months ahead, accompanied by heightened capital market activity. To decide where share prices head, he says while they prefer large cap cyclicals over defensives, at the sector level, financials appear to offer the best risk-reward ratio. He says they're also overweight on technology, consumer discretionary, and industrials. They're underweight other sectors.
Well, another view coming in from Vikas Jain of CLSA, who says that as over 90% of FI money invested in India is non-India dedicated, a risk of selling in India to fund any reallocation to China is a real one. He says we experienced a similar correction in India when Chinese markets spiked up in November of 2022. He adds from the list of large stocks that are up over 40% in 2024 so far, the most vulnerable to profit taking are likely to be some quote-unquote Modi stocks. And names that he gives as examples are Oil India, BHEL, IOC, Ambuja Cements, and some real estate plays like Godrej Properties and Macrotech developers. Some excited auto names like Bajaj, as well as expensive discretionary plays like Voltas.
Okay, so pretty interesting, saying that there is a real risk of some profit taking in India and a tactical allocation towards China. We saw some of that yesterday. Was it a one-off? That's the big question.